Welcome, everyone, to episode 5 of the Mindful Millions podcast. I'm your host, Cristina Perez, and today I am joined by an incredible guest, my realtor, Ryan from Long Realty. Ryan has guided countless clients through buying, selling, and investing in real estate. And today we're going to explore the foundations of real estate investing and how to build wealth without becoming house rich and cash poor. So, Ryan, can you please tell us a little bit about your background? Where are you from? And tell us about your background in real estate.
Yeah, absolutely. So I'm originally from Toledo, Ohio. I moved out here to Arizona in 2008. I'd never been to Arizona. I didn't know anybody. I came out here in January and it was blue skies, palm trees, and no snow. I said, I'm sold. People told me like you should check it out in the summer. I go, I'd rather shovel sunshine than snow. So I was in from day one. And so 18 years later, it's been a fantastic experience and love being here.
That's awesome. And so, how did you get into real estate? What were you already in real estate in Ohio?
So I started out as a real estate investor. I bought my first duplex using my VA loan in 2005. So I was prior military, got out in 1999, went to college, got my bachelor's degree in '04, bought my first duplex in 2005. Knew nothing about real estate, knew nothing about real estate investing.
What did you get
I
your degree in? Just curious.
human bachelor's of business administration with a major in human resources management. So I also
Awesome.
had a 20-year corporate career as well
Oh,
in
I didn't
this.
know that about you. Or I must have
Yes.
forgotten that.
Yes. So I worked in the corporate sector and that allowed me to purchase more real estate. So as of today, we've got 15 units between here and Ohio. I still have properties back in Ohio.
That
Single
is
family,
awesome.
multifamily, and 20 years I've seen quite a bit, but yet there's always something that will surprise me.
Always plan on things that have never happened happening, or things that
Right.
have never happened happen all the time.
Exactly. Yeah, exactly. Yeah, for
Yeah,
sure.
that's the uncertainty of the housing market and all economic markets, really.
Right, right.
We can only
Exactly.
speculate.
And one of the things that I've learned is that you surround yourself with people that know more than you do.
That is
And
definitely a
and
good tip.
and I didn't. I didn't know anybody that really I was starting out. I would think I was maybe 28 years old when I bought my
Okay,
first one. My parents were
awesome.
like, don't be a landlord, it's a horrible idea. But every book I read said the quickest way to build wealth was through owning real estate. So I went down
Yeah.
that I went down the path less traveled within my family because they all thought I was crazy at first.
Yeah, well, proud of you for having the courage to go against the grain and for reading those books.
Yeah, yeah, for sure. Yeah, for
Um,
sure.
and I'm sure you have had experience now as a realtor selling
Yes.
homes, or have you actually experienced clients who bought their dream home, but then later realized that they might have purchased too much house, meaning that they were feeling the financial strain of that new mortgage payment? How often do you come across that?
So I try to my whole goal is to educate people, especially my first time buyers. I've got a good portion of my clients that are first time buyers, not been through the process before, kind of like how does all this work? And when I bought my first property, I didn't have that education piece. It was kind of
Hmm.
like, here's a duplex. Does it cash flow? Yes. And I remember I signed my first purchase agreement on the trunk of my realtor's car.
Wow.
So we wrote it up. We were standing in front of the house in December 2005. We wrote it up on the trunk of her car and I signed it. Now things are a little bit better, DocuSign, things like
Yeah.
that, but maybe it's a Midwest thing. But yeah, that's what I want people to understand is that more is not always better because
Hmm.
if you've got more home than you can afford, you don't want to be house poor.
Hmm.
And what that means is that you've got more house than you can financially afford because you want to buffer in things such as repairs that come up unexpectedly, things
Hmm.
that are out of your control, like tornadoes, hail, monsoons, as we have in Arizona,
Yeah.
old pipes, that kind of stuff there. And, one of the things to take into consideration as well is when you do your inspections, things that could potentially come up that maybe at the end of their life, and you can kind of
Hmm.
prepare for it a little bit.
Like
So,
old pipes.
yes, like old pipes. Yes.
Um, but actually, a statistic that I wanted to share from Zillow is that the average new homeowner underestimates maintenance and repair costs by 40%.
Wow.
Yeah, that stat kind
Yeah.
of blew my mind. And as a certified financial planning professional, clients with a home purchase goal or an upgrade whole or home goal, or even wanting to simply invest in rental properties to create, as you said, that extra cash flow.
Hmm.
Um, but it definitely becomes an emotional decision, and you have to ensure that you're being mindful that it is truly aligned to your goals and your preferences. Because
Yeah.
if you don't enjoy managing people and a property, then you're going to have to factor in at least a property manager, and that means less of a return. So, therefore, it might not be
Right.
such a lucrative
Yep.
investment after all.
And if you've got an HOA as well. So
Hmm.
when people will approach me and say, "What about a condo or a townhome?" I'm like, the concept sounds good, but if you look at condos and townhomes and the HOAs, they could be three, 400 or more a month.
Hmm.
That's gonna be a huge chunk of your cash flow that's going right out the door.
Yeah.
So, that's one of the things that I would say, if you happen to be a landlord on accident, meaning that, okay, you lived in this condo and townhome, you bought it owner occupied with the purpose of living there, life threw a curveball where you had to move out for whatever reason, but weren't really in a position to sell it, so you decided to rent it. That's where you become a landlord on accident. But if you're going strictly for the fact of, I want to buy an investment property, I want to get a condo, one of the
Hmm.
things to just keep in mind, HOA fees.
Yeah. I actually grew up in a townhome, so I'm very familiar with the
Yeah,
HOA because my
yeah,
dad also was the treasurer for the homeowners association. It actually became a problem because we would be having dinner because it just so happened in that association, the president did not speak Spanish and the community was primarily Hispanic. So whenever they had a problem, instead of going to the president, they would come to our house and,
sure.
interrupt our dinner.
Yeah, yeah,
Um, but yeah, all and that's actually just another nuance of living in a townhome community, right? If you then took on the role of being a part of the homeowners association. That's
yeah.
a whole different topic for another episode.
That's getting involved more than maybe you should sometimes.
Yeah, but the goal of today's episode is really about grounding real
Yeah,
estate dreams
yeah,
in financial wisdom, which we're going to be talking about guidelines and resources that people can use on their own. And ultimately, the goal is to learn how to invest in property
yep,
while maintaining cash flow, flexibility, and peace of mind.
correct. Yeah.
So now talking about those early lessons that you learned when you bought your first properties. Talk to me about maybe what was the biggest eye-opening moment. And actually, I wanted to share to give listeners a little context. You really helped me facilitate my parents' real estate transaction, and they live in California, but I live here in Arizona. So I was really the one seeing all the houses with you, helping get the documents signed and all of that. And thank you so much for the guide that you provided. Like you said, that education just gave me a nice overview of what the process was going to look like, which creates a little more comfort, I guess.
Clarity and
And
confidence is my goal,
yes,
is to
those
make
are the
sure.
two things that I also hope to help clients have with their financial decision making. So it sounds like
Right,
you're doing the same for real estate investing.
right.
But go ahead and share your story about maybe some early lessons.
Oh man, there's a lot. I don't know if we have all day, but for me, when you're looking at a property to invite, and we're talking purely investment perspective, right? Not
Hmm.
homeowner occupied. So, my first purchase was a duplex, 1 bedroom, 1 bath. It's because what I could afford. Now, hindsight's always 2020. Renting a 1 bedroom, 1 bath is tough because most people want 2 bedrooms, 1 bath, or maybe some more space, that kind of stuff. But I worked with what I was able to afford.
Hmm.
And so that's the biggest takeaway that I learned early on was don't overextend yourself. Okay.
Hmm.
Second is having reserves for those unexpected things. I mean, you could do all the inspections, everything's great. A week later, from after you close, something can go wrong. So anticipate that, build that into your rent. Um,
Hmm.
the third thing is I noticed that you had a post on Instagram about LLCs. Asset
Hmm.
protection is number one, and treat it as a separate LLC because there's a thing called or piercing the corporate veil.
Hmm.
Don't commingle the money. Don't dip into the till, so to speak, of like, hey, I got 5 extra grand. How about I just take, $100 out for myself? Truly treat it as a business entity. Um,
Yeah. And what I was even going to mention, if you didn't go as far as creating an LLC, as at least create a separate bank account,
yep,
for the rental property maintenance and, whatever security deposits that maybe tenants also provide that you just simply need to hold and then
right.
provide back at a future date. Um,
Correct. Because as a landlord in Arizona, you need to understand tenant landlord law. Now, I'm not
mhm.
saying be an attorney, but know enough to keep yourself from getting in trouble. And one of the biggest things landlords get sued over is our deposits.
Yeah.
And not returning them or saying, "Oh, I get you've incurred all these damages, and so therefore, I'm not going to give you your funds back." There's a very specific process in place in order to manage that piece.
Yeah. Yeah. And I can see how maybe they just spent them and didn't expect the tenant to move out when they did, and then that could cause, you know.
Or they're just gonna just kind of pad the expenses of the damages that were done
Hmm.
and
Yeah.
didn't give the tenant that moved out an accurate accounting.
Right. Yeah.
So
Luckily, when I lived in an apartment in North Scottsdale, I got the majority of my security deposit back.
always something, isn't there? The
I did
majority.
hang a lot of things on the wall, so I
Yeah.
expected not to get all of
Yeah.
it.
But
um, Go
the
ahead.
other thing too, is find some good people that could do some work for you. So
Hmm.
if you've got a handyman, a plumber, electrician, that kind of stuff, they can save you a lot of money. I spent a lot of money on things where I shouldn't have paid as much as I did, but over time you
Hmm.
start to build that circle of people.
Yeah. But also, if you get what you pay for, and sometimes trying to pay the least amount
Yes,
could result in a bad job. So,
absolutely. And I've done the Craigslist thing and I kicked myself in the butt for it. And
yeah,
I came to Arizona. I bought a 4 unit building down in Old Town Scottsdale.
nice.
And I didn't know anybody here. It was a foreclosed property. It was a complete train wreck, but I had the vision of what it could be. And
Hmm.
yeah, I got raked over by contractors. I got raked over by the Craigslist guy. And I'm
Wow.
like, man, whoo, now this one is a good example of I got a great property at a great price, but I didn't fully understand the amount of work that needed to be done to it.
Tell me more about that, because I think
Uh,
that's the common pitfall that I see in my financial
yes.
planning
I mean,
clients.
I knew it was a foreclosed bank-owned property, so no repairs were going to be done. It is an as-is sale. I knew that the AC units were old. I knew there was some old galvanized plumbing. The windows were original single pane aluminum windows. Some of them were busted out, some of them were sealed up. Most of the units were infested with cockroaches, so I had
What?
had had that going into it as well. So I bought it owner occupied. So I actually
Yeah.
lived in it for 3 years. And
Wow.
I
Okay.
took the least disgusting units and did a lot of work to it. Um, and I didn't fully understand how HVAC worked and how
Okay.
I've got 4 units now, 4 of everything with a fourplex. So 4 times the potential issues. Um,
Wow.
and I got suckered into paying for some payment plans and some, maintenance stuff and things that I just didn't really know about.
Hmm.
And come to find out that I shelled out a lot of money for things that really didn't provide me any value at the end.
Yeah.
So,
Yeah. You live
especially
and you
AC
learn.
in Arizona, you know. But
Right.
fast forward 18 years later, now I'm a lot wiser because I've taken a lot of lumps. So when I'm working with a client that's wanting to buy their first investment property, I'm like, here's my playbook. And let's look at these things, and I can tell you from my own experience how it can play out. Now, I don't have a
Hmm.
crystal ball,
Mm-mm.
and
No one does.
when you buy an older home, then there's always going to be that potential for things, down
Yeah.
down the road.
Yeah, and as a financial planner, when it comes to budgeting, which includes your housing expenses, which your
Yeah,
mortgage or rent payment is a part of your housing expenses, and your total debt to income ratio, there's the 50-30-20 guidelines. Are you familiar with those budgeting guidelines?
I'm not. Go ahead and give me an education on that one.
So it's based on your take home pay. So
Okay.
already, well, for most W-2 employees, you have your federal taxes withheld. And so your take home pay is after tax money. If you're
Hmm.
self-employed, it would be your gross income minus the amount that you should be saving for savings, which includes a self-employment tax. And then that amount remaining would be your take home pay. So
Yeah.
out of your take home monthly pay, 50% is recommended to be used for total essential expenses, the needs, and then 30% should go to wants, discretionary expenses, leaving 20% for additional savings. And if you're contributing to
Right.
a 401k as a W-2 employee, then that means you're already saving for retirement. So then maybe this 20% can go for a home purchase goal, or it can be saved for a home purchase or early retirement or college savings for those
Yep.
young families. Um, but what I typically see is a lot of clients, if it's not too much house, it's too much car. But the bigger one that I see most often is house, or really it's a combination of house and car.
Yeah.
But what I see is people spending 70, even 80% of their take home on just fixed, essential, or not even fixed, it could be fixed or variable, but their essential living expenses. And if, there's a young couple that I definitely saw this, they were making high income and their first home, and they already had bought it by the time that they started working with me, but they were acquiring debt and they were trying to figure out why. And it's because their almost $4,000 monthly mortgage payment was eating into their about $11,000 monthly take home. So they
Yeah,
were
that's a
definitely,
yeah, that's almost what 50%, like 40
yeah.
some percent. Yeah,
Or 4,000 divided by 11,000.
yeah,
I don't have my phone with me right now.
yeah, but yeah, it's a lot. Yeah.
Yeah. And so on top of that, they had car payments and debt payments. So that's the reason they were really feeling that
And then
strain.
you
And
got to eat,
oh, and then on top of that, they were severely overspending on eating out, shopping, and entertainment, and those are the discretionary categories. Uh,
Yeah,
this couple is doing well now. They got their spending in line with a
good.
budget,
Well, because
which
they have you. That's why they
so
have you.
I wanted to talk about, being house rich and cash poor ultimately, and I've seen this in very rich clients who are making a ton of revenue, they have a lot of assets, but then they don't have liquidity, meaning
Yeah,
cash, and that equals stress.
right.
And what isn't the point of acquiring all of this wealth and money to feel more at ease and at peace?
I would think so. Because a lot of the properties I bought were the early 2000s, or I don't know what you'd call it, the late 2000s. So 5, 8, 12, 11, 12, and 13. And then the last one was in 17. Um, and obviously there was a time when the the real estate market was doing this, and then
Hmm.
it just did that over
Yeah.
time. So I was able to ride that appreciation wave really nice, but it's still not without, I've got an eviction going on right now.
Oh,
That's just,
really?
yep. Got an eviction, had a loss, settled a
In what
lawsuit.
state
No,
is the eviction?
here in Scottsdale. Yeah.
Oh,
Yeah.
okay.
Yeah. So when you have 15 units, you've got
Hmm.
15 potential problems at any given time. So as you those that's one of the other things too, is that it's not it's not a sexy business in regards
Hmm.
to, you buy a house, you get the deed, you throw it in the drawer, and money just rolls in. I have property managers for Arizona and for Ohio, but I got to manage the manager too. So as you
Exactly.
as you start to grow your portfolio, you're still very much involved in things. And
Yeah.
especially when you got an eviction, or you're have an issue with the contractor, or you've got a big ticket project such as you've got to replace some plumbing, some pipes and stuff like that. You're
Hmm.
still you're still very much hands-on because you want to make sure it gets done, type of
Yeah.
thing. So
Yeah.
um
And I wanted to pose the question to you, how does or what does being house rich and cash poor mean in your words?
house rich, cash poor, meaning you've got a ton of equity wrapped up in real estate, but you're not doing anything with it. So there's the thing called a 1031 exchange.
Hmm.
So, as you start to grow, one of the things you can do is, if you got all that equity, you can parlay that into something bigger and better. So say I wanted to go from a 4 unit to a 12 unit or 16 unit. I mean, depending on what the price points and the equity is and stuff like
Hmm.
that. Because the equity is not doing anything for you, that it's tied up in brick and mortar. It's great to talk about at cocktail parties, but how are you truly leveraging that to your advantage? So
Yeah, and that's definitely a good point, or you made me think of that. Buying the property is one whole process, and then maintaining the property is a whole other process. But then getting out or upgrading the property, like you said, and actually
yeah,
part of maintaining it, the tax benefits of accelerating depreciation of rental properties, not primary use residences.
correct.
Um,
Yep,
but that could be the reason why it wouldn't make sense to just sell the property and realize a huge gain and instead 1031 exchange it. And hopefully your kids or your heirs inherit it, and then they can get a step up in the cost basis, and then that will
exactly.
minimize the gain. And that is how you do some tax planning and estate planning and investment planning.
Yes, and it definitely evolves as you start to add more properties. You've got to think of those things. You've got to think of asset protection. You've got to
Hmm.
think of estate planning. And what happens when, because nobody leaves this party alive, right? And what happens when
Correct.
you pass on? Who does it go to? And you don't want to have it in probate and tie it
Hmm.
up. And for me, it's about creating legacy
Hmm.
for somebody, and passing that on to them and giving them the opportunity to have something that I didn't have.
Yeah.
Um,
Legacy and cash flow is what I was
yeah,
thinking.
legacy and cash flow, right? Managing your rents too. I was not good at that at one point in time. I took the approach of just kind of keep it even, keep it quiet, and go from there. And then what
And
happened
never
was
raise it?
there were times I didn't, and
Okay.
I I'm more I'm a pretty conservative person just by nature, just not too much of taking uncalculated risks. So
Yeah.
um sometimes I like to pride myself that I've got people that have been paying me rent for the last 12 years. But the reason is because I've kept the rents low to where the market has outpaced what I'm currently collecting in some cases, not all.
Yeah.
I finally got a lot of them caught up as people turned over and things like that.
Right. Yeah.
So it was a good approach from the fact that I had very low turnover. It was a bad approach from the fact that how can you bridge a $500 gap or $600 gap with somebody? You can't just, when their lease renews, say your rent has just gone up $600. I
Right.
mean, that's not fair to that person. And I'm sure some people will listen to this and say, who cares about being fair? I have an
Yeah.
approach of that they're people too. So
Hmm.
kind of treat them with dignity and respect. Um,
Right.
but at the same time, yeah, I shot myself in the foot a little bit.
Yeah, because as a financial planner, just thinking of it purely logically or rationally, inflation is the average 2 to 3%. So it is fair, at least annually, in my eyes, and this is what I recommend clients do, to increase that pricing. And this really applies to pricing in general, because I
Yeah.
remember reading an article where they were talking about how it is so much better for the client experience or renter experience to raise prices steadily, like 2 to 3% every year. And what
Yeah.
that does psychologically is get your client comfortable to that increase, and they expect it and they can plan for it. But when you don't do that for 5, 10 years, and then all of a sudden it's a huge jump, they're
Yep.
gonna not like that.
Lesson number 50 on being a landlord. Incremental increases, because to your point, if you go a number of years without them and then you start to implement them, then they're going to be like, well, why are you raising my rent now?
Yeah, they
Type of
feel it
thing.
more.
They feel
Hmm.
it more, right? So that's another piece I would advice I would give to somebody as well is, obviously don't raise it above what the market is bearing,
Hmm.
but at the same time, incremental increases, even if it's $100, $150, I mean, depending on where
Yeah,
you are, it conditions them to expect that year after
yeah,
year. Yeah,
yeah, yeah.
yeah,
And overall, making it a smoother ride for everyone, hopefully.
yeah, yeah. Because you're in to win. You're doing this for cash flow. You're not doing this just for the heck of it. So
Yeah, and one of the main tools that I wanted to have listeners take away is free online calculators are how you can avoid ending up in the situation that we're trying to help you avoid, which is too much house or too much car. Keep that in mind. But I would definitely recommend checking out a total debt to income calculator. The guideline there is no more than 36% of that total monthly take home should be going to your debt expenses, which would be your
right,
mortgage, your car
yeah,
payment, credit cards if you have those.
yeah,
But it is, if you're using your credit card every month for your budgeted expenses and then you pay it off, that's different. Then you're
yeah,
not carrying credit card. But there's also housing expense calculators, and the goal for housing expenses, which doesn't include your car payment and any other debt payments, but it would include maintenance, for example, and property taxes if you ended up buying a home. But the goal would be to be under 28% for the housing expense. And
right,
then there's rent and mortgage payment calculators. That's really if for the mortgage payment, if you're going to take out a loan to really see, depending on the interest rate, the amount that you're financing and putting down, what is that monthly payment going to look like? And then a take home pay calculator. And then lastly, creating a budget is really how, and
yeah,
using that budget regularly is how you will avoid ending up in this place.
Correct.
But
Yeah, absolutely. Yeah. Real estate could be an absolute boon to somebody's portfolio and creating wealth, or it can absolutely crush you financially.
mhm,
And I've seen a lot of people early on get wiped out. And one of
yeah,
the things that I would say is I always got a 30-year fixed loan. And I see people that they were, and this was back in the day, in the early 2000s, where people were doing 100% financed, no skin in the
mhm.
game, interest only payments. I mean, you're not even touching
Oh,
the
yeah,
principal.
yeah.
You're just you're
Oh,
just you're sending a check and you're creating absolutely nothing. You're essentially renting your house.
yeah, and I
You're,
remember I had clients who would be very happy that they're only paying interest, and I'm like, Wait, do you understand what's happening?"
do you understand? Do you understand what that means? You're basically renting your house from the bank, and you're
And it's a short-term benefit, right? The lower minimum payment, but it's a
yeah.
long-term disservice.
And then it adjusts and stuff like that. So, I mean, I'm always been an advocate of the 30-year loans. That's what I had on some of them. So I'm at the point now, some of my properties are completely paid off.
That's
So,
awesome.
it's kind of a mixed bag of some have loans, some don't, but
Mhm,
you can always refi your interest rate if it makes sense to.
mhm.
Be careful of that. And the other thing is understanding your amortization table, because if you look at it, and I didn't know this either, I just found this out over time. The first 7 years is where you're paying the most interest before you
Oh,
even
yeah.
start getting into your principal. That's why lenders start calling you all the time to refi. They just want to keep you on that treadmill.
Yes. Yeah, because if you do refi, and that was the point that I was gonna make, and even worse, if you do a cash out refi, you're only creating a even bigger loan, and who knows
Mhm.
where interest rates are at that point.
Right,
Um, but it's a
right.
slippery
It
slope. Yeah.
that first 7 to 10 years, that's where you're paying the most interest. And they're like, hey, look, you can refi. And then you're just refining back to 30 years. So you're never getting on.
And there's an
Once you start
origination cost usually to create that new loan.
exactly, exactly. So that's another thing just to kind of look at is, cashing out, does it make sense? Are you at a point to where you've got enough to cash out? And do you have a plan for that money as well, too? And just all these little nuances that come with it that really nobody told me about. And I just had to learn either through my own or just kind of take my lumps. And I'm like, well, that was dumb. Don't do that again,
Yeah.
Ryan.
Yeah.
So
Definitely from our
that
mistakes.
yeah, that kind of stuff there. So and that's I'm at that point in life now that I really get satisfaction out of helping people walk through those issues. Because
Mhm.
even when I bought the fourplex out here, I remember vividly the realtor I used gave me basically a list of properties, said, just go drive around, take a look at them, let me know, and then we'll go from there. And I'm like, I don't even know where the hell I'm driving. I just moved here from Ohio. Metro Phoenix is huge. I was in Mesa, I was in Tempe, and this was before iPhones where you could just Google it and just in. I had like 8 sheets of MapQuest. Yes, I'm
Oh
dating
my
myself.
goodness. I
And I
I
had the
printed some map.
I had the MapQuest it all. Turn here, turn there, go straight, turn left, and I'm like, oh, geez. So for me, in it's constantly an evolution, or is constantly evolving, is making the client experience a good experience. And
Yeah.
and I'm always looking for ways to improve it, to make it better. Did that help you? Did that make you feel confident? Did that make you
Mhm.
feel special, or as a differentiator from the 60,000 other licensed agents in Maricopa County?
Yeah.
And I want people to fully understand everything that we're doing in the transaction. But for
Mhm.
me, it's the post transaction that's even more important, because I want to build a relationship with people, and
Mhm.
relationships are huge to me. And
Yeah.
just keeping
Well,
in
I'm a
touch.
witness. Yeah, I
Thank
definitely
you.
have enjoyed
Yes.
building that relationship. So we purchased the house with Brian back in October of 2023. So actually,
Yes. You
my
just had your 2-year
anniversary is
anniversary.
no, it's on the 16th. I
Is
thought
it on the
do I,
16th? Okay.
I
Okay.
don't remember, but so yeah, it's been 2 years. We've had
Yes.
lunch. We've kept in contact, and now I got to have you on as a guest,
And
which
your
has been
birthday is
great.
this week too.
It sure is. Yeah. And sorry, listeners, for not airing this episode on the first, but we will get it out before the end of the month. Um,
Yes.
but I did want to ask, what's your opinion when you hear people saying that renting is throwing money away? Do you think that there's a time where renting might make more sense?
So, couple of questions there. So, first and foremost, I think absolutely renting is throwing your money away. Um, yeah, absolutely. Uh, My my retirement was built on other people's money by renting. There's a place for it. There's a time, there's a place for it. I never
Hmm.
rented. I went from the military, I boomeranged back with my parents, went to college, bought a place, and have always owned. So I've never signed a lease. But is there a time for it? Does it make sense? Yeah, absolutely. I've got a number of clients that have moved here from different states and are not familiar with Metro Phoenix. So a scenario
Hmm.
like that, it's good to rent at first to understand the area. Do you even like
Yeah.
Arizona? Have you been through a summer? You can go through a
Yeah.
summer and say, I'm out, tap out. This is not for
Yeah.
me. That's good. Um, Renting in the fact that you're not mature enough or responsible enough to handle home ownership because
Hmm.
of maintenance, of things that come up, of the responsibilities of owning a home. It's a privilege to have the ability to own a home. And then the third one is, are you financially in a position to own a home?
Right. Yeah.
Now, there's always the old saying of, well, I'm going to rent and try to save up. Sure, but sometimes your rent is going right out the window, and are you really saving up to do that? Some people yes, some people no. So renting is good for some people, but it
Yeah.
all just depends on the scenario. But I wouldn't
Yeah.
say it's something that I would encourage somebody to do for 20
Hmm.
years. And
Yeah.
I've asked my tenants that rented for me for 14, 15 years, and I'm like, for the money that you just paid me, you could have owned your own home. And they're like, I just don't want the responsibility. If something breaks,
Yeah.
it's not my problem. And I'm like, fair enough.
Yeah.
That's
Exactly.
fair enough.
I would say it definitely makes sense out of necessity, like you said, when they
Yeah.
don't have the funds, even maybe to just get approved for a home loan, but
Yeah.
then to cover the maintenance costs, which going back to that stat, 40% of us underestimate maintenance and repair costs.
And then
Um,
I think there's also a break even point too of the rent that you're paying is more than what you could pay for a home too.
yeah, hopefully that's not. Well, yeah, there's definitely people in that
Yeah.
scenario living in luxury, rent
Yeah.
apart or
Yeah.
$6,000 monthly apartments
Yeah.
that exist here in Scottsdale.
Yes. Yes, they do. But you know what? It's the experience, it's the amenities. I mean, and everybody's at a different point in their life. So
Yeah, and so I said necessity, and the other kind of way to summarize it is preference. And
yeah.
some people have finances the means, but they don't want the responsibility. So
Yep.
that's the way that I approach it with clients. Do you have are you in a good financial position to do that? And also, do you understand what you're signing up for? Or at least are you willing to hire a property manager so that,
Yeah.
because at the end of the day, it's an investment, it needs to be maintained. Well, it's also a physical hard asset. And
Right.
that's why it requires more time and effort than if, let's say, you invested in a real estate investment product like a mutual fund or ETF or a
Yeah.
real estate investment trust. So, yeah, different ways to invest in
Yep.
real estate, which today we were really focusing on the hard
Yeah.
real asset. but go
I
ahead.
and one thing I would caution people to stay away from is crowdfunding of multiple people pooling all their money together to buy real estate. And the reason is one, you've got all these people throwing their money in one pot and you got one person managing it, so to speak.
Hmm.
One, where's the oversight? Two, I've read that there's fees involved, a lot of fees, that kind of stuff. Three, I've been down that road and we had all the money taken.
Wow. What do you mean?
So it was 2014 to 2016. We were investing in non-performing notes, non-performing loans. So these
Hmm.
were these were loans that they were behind on their payments. And the investment group that we had together is that we were buying up these loans, working with the owners and getting the loans back to where they're performing, meaning that they're paying on
Hmm.
time, they're paying their debts.
Okay.
So there was maybe 10 of us here in Metro Phoenix. We all kind of knew each other, and each of us put in a certain portion. And for that, we were getting a pretty generous rate of return, around 11 to 12%. So we would get that money back every month in the form of like a dividend. And
Hmm.
then one day the check stopped coming in.
Yeah.
And 2 days later, we got the email saying there's been issues, blah, blah, blah. Come to find out, the person ran off with the money, hired an attorney, had to get a forensic accountant. Um, some guys had about $1 million in there. I didn't have that nearly that much, but
Wow.
still at the end of the day, I think, we only walked away with a small percentage of what we initially invested. So choose your bed partners wisely, even if you do a
Yes.
joint venture. And joint
Yeah.
ventures are short term and stuff like that. So when people are like, "Yeah, I'm getting involved in crowdfunding and we're all going to pool," because it's a
Yeah.
it's a lower barrier to entry versus getting a loan, having the whole thing on you, all
Right.
that. It seems like it makes sense, it's smart, but
Cost sharing,
cost
really.
sharing, right? But at the end of the day, and again, I've been through it, walked away with nothing. So, and that
Yeah.
was in my self-directed IRA. So that was part of my retirement account. So
Ouch.
yes. So
Because you
like I
can't
said,
even benefit from a loss there.
excuse me?
You can't even benefit from a loss in a
Nope.
retirement account if that
Nope.
was
No,
maybe,
that money's
yeah,
gone. That money's gone. So um careful who you do business with and who you
very good
you you
advice.
you sign up as your partner. And
Keep an eye on those fees. And
well,
I'm a
yeah,
big
yeah.
proponent, or I like to tell clients, keep it simple, simple before
Keep it very
sexy.
simple. We're not, the Donald Trumps of the world, or the other big real estate investors. We got small portfolios, more than the average bear, but we're not heavy hitters by any means. But it's sometimes the term of less is more applies.
I
That's
definitely
yeah.
resonate with that motto. Yeah, I
Yes.
definitely feel like a lot of Americans, because the American dream is to buy a big house, but it tends to lead to people attaching their ego and their identity
Oh
to
man,
their assets or their
so much
materials, their
ego.
home,
Yes.
and
Yeah.
ultimately that is going to create less flexibility because you have less cash flow,
Yeah.
less liquidity, and that's going to create more stress. And the whole point of, for everyone who is trying usually to work with a financial planner, the common goal is financial freedom, right? And that really
Yeah.
means having the
Yeah.
flexibility to do whatever you want for as long as you want with whoever you want. And when we're taking on these huge essential expenses that, could be 30 years, and then if you refinance 7 years in, you're restarting that 30-year clock. But the
Yeah,
point is that
exactly.
is all for status. So I think clients really need to understand that buying less house means more financial freedom.
Yeah, buying less house and buying something that is you can afford. And there's nothing wrong
Hmm.
with starting out with a smaller home. I started out with a duplex, one bed, one bath, a one car garage, a basement, which was really nice. And and I still own it today. So that's, oh God, 20 years.
Wow.
Yeah, it's crazy. Oh man.
Yeah, you definitely built up a nice portfolio. That's incredible.
And then you can, even if you really want to start getting savvy, you can start looking at other alternative investments, using like a self-directed IRA. You can get into private lending, buying notes, stuff like that.
Hmm.
Land. I started buying up just a couple parcels, or more than that, few parcels of land here and there in areas of Metro Phoenix that I think are ripe for growth. And it's dirt and
You
the
can lease
taxes.
it,
Excuse
right?
me?
Like you can maybe just lease the land and then someone
Well,
can
it's
build.
pretty rural. It's down in Eloy, around
Oh, okay.
Arizona City. So, I mean, I if you asked me where it is, I couldn't even drive you there because there's no utilities, there's no paved roads. The good thing is it's already subdivided and zoned for residential.
Okay.
So in the taxes per parcel, they're maybe quarter acre a piece, are only $13 a year.
Oh,
So
wow.
so I was able to pick it up using the term dirt cheap,
Yeah.
and just kind of hang on to it and see what happens, because a lot of growth going on down there in Casa Grande, Eloy area, that kind of stuff. So the goal is that one day have a developer call me and say, "Hey, your parcels are in my way. How much do you want for them?" So
Well, the way that I see, the development happening, it's
yeah.
just a matter of time before we get all the way out there.
Yeah, exactly, exactly. So as you progress in your real estate investing venture, you can start getting into doing other cool alternative things, and start looking at 1031 exchanges and that kind of
Hmm.
stuff there. So it has a lot of rewards. It's offered me a lifestyle that I couldn't have had just by just a corporate salary,
Yeah.
and is giving me some of the leverage that I have now to do the things that I want to do, that you couldn't get by just in the stock market, or just by sticking it in the bank at 0.001% interest.
Yeah. Or, that 1031 exchange
That's
option or
huge.
accelerating depreciation. You can't,
Yep.
well, some of those real estate investment products like private credit, they do offer some tax advantages, but
Right.
it definitely doesn't beat actually having a rental investment property.
Yeah.
Um, but the reason why a 1031 exchange would make sense, I definitely wanted to make sure to mention the 25% recapture that would happen if you did sell the property and had depreciated, a good amount of the cost basis, because
Yep.
then that means a big tax bill that I think a lot of Americans don't expect or don't understand,
Yeah.
that you might get kicked on the way out if you got all of those tax benefits and you didn't do a strategy like a 1031 exchange to
Yeah.
continue to defer that capital gain.
Exactly. And if you just go ahead and you sell the property, then you're gonna pay a hefty capital gains bill at the end of the day. So
There is the exclusion for singles of 250,000, but that would be for a primary residence, so
right,
not
it's
an
the
investment
homestead.
property.
Yeah. Yeah,
And then
I
if
think
you're
it's
married filing jointly, 500,000.
500,000. Yeah. And most people, if you've owned a home in Metro Phoenix, um, for the last, 5 years or 10 years, most likely your home is worth more than 500,000 now. Median home price is around 450 or so. So, um,
But keep good records of those home improvements as well to increase the cost
yes,
basis.
yes. I again, not the most diligent of that. Early on, I had the proverbial shoebox full of receipts that I would just send to the CPA, and kept it all on a spreadsheet. And when it's March of the next year and you're trying to figure out what that cost was, and April of the previous year, and you're like, I don't know, you know?
Yeah,
So
that's definitely,
yeah.
I'm helping my parents do the record keeping for this rental property. It's a lot of Excel sheets going.
Yes, yes. QuickBooks is good. But that's why I have a property management company because they handle all that now. I mean, and
Yeah, and I
then
wanted to ask if you partner with well, is it a CPA and a financial planner, or how do you incorporate this into your broader financial plan, like your
so
retirement plan?
yes. So yeah, we obviously have a CPA, have an attorney for the asset protection because there's multiple LLCs um here in Arizona and in Ohio. And then there's a structure for the larger portion of the estate in that as well. So you come to a point, and I say if you started getting more than two properties, you want to start looking at that because median home price in Arizona, say, is $500,000, 450,000. You got close to $1 million in assets, and say this is excluding your personal
Hmm.
residence. Then yeah, it's time to start to level up and look at those things. Because if your plan is to start expanding, then you want to have that infrastructure in place.
Yeah.
Yeah.
And that, when you say infrastructure, what do you mean by that?
LLCs,
Okay.
liability, asset
And the
protection.
team, the professionals?
Yes, 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 yeah, absolutely. Have a CPA that knows how to work with. I think it's the 10K or K1. I
Oh,
forget
yeah, yeah.
the K1 form for
Hmm.
investment properties, that kind of stuff. Start having a financial planner like yourself on board,
Hmm.
because you know you want to have that whole portfolio be a part of your future.
Yeah, and I really help clients who are maybe asset heavy and don't have
Yep.
the cash, and they're trying to figure out what is
Yeah.
the most tax efficient way to maybe sell some properties, at least to just start funding their retirement. But
Correct. Yeah.
doing that in a tax efficient manner, which means looking at how much, depreciation, does it make sense to do it 1031 exchange, or potentially just go ahead and sell? But
Sell, pay your tax bill, and then just do with whatever with the money. Because for me right now, it's kind of I'll be 50 in January, and so
oh,
kind of getting to that point of where I start to no longer just do residential real estate, but then just have, as the properties are paid off, just live off of the rental income
it's awesome.
type of thing.
That sounds
Or sell it and, sell one of them, sell one of the fourplexes and cash it in, pay the government their fair share, as they say, and then just do something else with the money, maybe something non-real estate related.
invest in a long-term diversified
That's
stock
where
and
you would
bond
come in
portfolio.
potentially,
Yep,
using
exactly.
your expertise on that. So,
Yeah, exactly. And
um,
so I feel
yeah,
like the takeaways of this episode is to buy intentionally and not
yes,
emotionally, and
yes,
to keep liquidity and flexibility front of mind, which is what will make you feel financially free. Whereas if you do take on too much of a mortgage payment or even a rent payment
yep,
or car loan payment, that is what is going to lead to stress. And ultimately, I think that also potentially can lead to overspending, when you're
yeah.
stressed.
Well, tenants
Um,
can lead to stress too. Let's not leave those people out. I mean,
Yeah, and I guess another takeaway is that real estate is a tool that comes with responsibilities. It's an investment that
Yes,
requires maintenance, which requires time and energy,
yeah,
and really factor that into your
yep.
decision making.
Things break. Things
Yes.
break, and you can have really great tenants, and you can have tenants of like, man, how this one slipped through the crack.
Yeah, exactly. So
So,
I wanted to remind the clients or the listeners that wealth isn't more. It's about owning wisely. So, like you said, sometimes less is more, and trying to build equity while maintaining cash flow so that
Yep,
you can breathe easily. Um,
absolutely. And this is a long-term game.
yes, exactly. And so, do you have any tips or maybe a challenge for listeners to complete over the next 30 days?
Well, I don't know about a challenge, but I would say tips if you're at the point of, yeah, this is mentally something I'm ready to commit to. I'm financially in a position to commit to it. It is get as much education and knowledge as you can, and then partner with
Hmm.
people that have done this
Yeah.
and can help you walk through it. Because in granted, I'm not trying to solicit anybody, but the agents that I had when I started out never went through any of the experiences, so they couldn't relate. It was very transactional. Like, oh, you want this
Mm,
property? Great, let's write an offer on it. They didn't say, here's some things to think
expect
about.
this.
Setting
Hmm.
up, but just even setting up in an LLC. Here's an accountant that you can use. Here's an attorney that you can use. Here's my vendors list of people that I have vetted and have used myself to help you with
Hmm.
repairs and stuff like that. So it's really build out your team of people that you know and trust that'll help you through those situations when they come through.
Yeah. Right.
Yeah.
There's a common saying, your network is your net worth, but it is true. It's the people you surround yourself with.
Absolutely. Absolutely. Have kind of your dream team together that can help you navigate through those issues and those challenges. Because
Yeah.
I didn't, and it was a lot of there were some sleepless nights. I mean,
Yeah.
especially, and I don't want to take up too much more time, but with the fourplex, I had it vacant, entirely vacant at one time. So there was no rent coming in. And I was like,
Yeah. Holding costs.
yeah, exactly. So
Yeah. And I was going to say, ChatGPT could be a good brainstorming partner or partner on
yeah.
your team. So don't forget about utilizing AI. But thank you again, Ryan,
Yeah.
so much. And happy early birthday in January.
Well, happy
All
birthday
right.
to you this week, tomorrow,
Thank
right?
you. It's on Sunday,
Sunday.
the
Okay.
19th. Yes. Well, thank you everybody for tuning in and stay tuned, follow and subscribe. And in the links below, I will include Ryan's information so you can definitely connect with him. And thank you so much.
My pleasure. Thank you. Have a fantastic rest of your week.
Thank you.
All right.